Ever felt like your global adventures, whether it's an overseas job, international investments, or even just getting a dividend from a foreign company come with this unwelcome side effect? Paying taxes twice on the same income. It's a really common and frankly pretty frustrating concern for so many of you out there juggling both U.S. and foreign tax obligations.
Indeed. Yeah, that specter of double taxation, it can be truly daunting. It basically erodes your hard-earned income before it even, hits your bank account. Understanding how to navigate this whole thing isn't just about ticking boxes for compliance. It's fundamentally about preserving your money. It's about fairness and taxation across borders.
And that's exactly why we're doing a deep dive today into a really fascinating and I'd say powerful corner of the U.S. tax code, Form 1116. This is the foreign tax credit form for individuals, estates, and trusts. Think of this as your essential shortcut, maybe your roadmap, to understanding how you can claim a dollar for dollar credit for taxes you've already paid to foreign countries or U.S. territories. And maybe more importantly, it's about how this, let's face it, seemingly complex form can actually unlock some significant tax savings, real impact on your bottom line. We're going to unpack this tool, focus on the smart strategies, maybe some less obvious facts that can lead to, well, substantial financial benefits.
Right. Our mission today is really to arm you with the knowledge to approach Form 1116 not just as, another piece of paperwork, but really as a strategic asset. We'll start by tackling that core choice, credit or deduction. It's a decision that can make a huge difference to your wallet. Then we'll demystify who actually needs to file this form, and maybe more excitingly, who might get to skip it altogether. We'll lay out what foreign taxes genuinely qualify for the credit, and crucially, what doesn't. That's just as important. Then we'll navigate the complexities of foreign currency conversion, always a fun one, and prepare you for how to handle foreign tax redeterminations. Those inevitable changes in foreign tax liability that pop up. And finally, we'll walk you through the form itself part by part. We'll highlight the key lines, the crucial adjustments, especially those relating to foreign qualified dividends and capital gains. By the end, you should have a much clearer understanding of this really essential tax-saving tool.
Okay, let's unpack this core decision right at the start. Because arguably, it's the most impactful choice you're going to make when you've paid foreign taxes. You've generally got two paths: claim a credit or take a deduction. So what's the big difference, and why does this matter so much for your wallet?
What's truly critical here is the immediate and direct impact on your actual U.S. tax bill. A foreign tax credit gives you a dollar-for-dollar reduction of your U.S. income tax liability. So imagine your U.S. tax bill says you owe, say, $1,000. If you have a $500 foreign tax credit, boom, your U.S. tax bill immediately drops to $500. It's like having a coupon,
Oh,
takes money directly off the total owed. This is almost always the more advantageous option because it directly offsets what you owe the IRS.
that sounds incredibly powerful. Yeah, a direct offset is definitely more appealing than just lowering your income number. So what's the alternative then, the deduction? How does that work?
Right. Conversely, deducting foreign income taxes on Schedule A of your Form 1040, as an automized deduction, that only reduces your taxable income. So let's use an example. Say you have $50,000 of taxable income, and you take a $1,000 foreign tax deduction. Your taxable income just becomes $49,000. Your actual tax savings then depends on your marginal tax rate. If you're in the, say, 24% tax bracket, that $11,000 deduction only saves you $240 in U.S. tax, right?
Yeah.
$1,000 times 24%. Compare that to a $1,000 foreign tax credit, which would slice a full $1,000 off your U.S. tax liability. So the credit is almost always significantly more powerful as a tax-saving tool. It gives you that direct reduction, not just a reduction in the base your tax is calculated on.
Okay, so the credit is typically the clear winner. Makes sense. But, in the world of tax, there's always a but, isn't there? Are there any really specific, maybe unusual situations where someone might actually be better off taking the deduction? Or maybe situations where you can't take the credit, but you can still take the deduction?
That's a great question, because while the credit is generally way better, knowing the exceptions is really key to avoiding pitfalls and, frankly, maximizing any available relief you can get. The general rule is, if you take the credit for any eligible foreign taxes, you generally cannot deduct any part of that year's foreign taxes. It's usually an all-or-nothing choice for taxes that could qualify for the credit. However, there are certain foreign taxes that, even if you paid them, are not eligible for the credit but can still be deducted. And this brings up an interesting point. Why would the IRS let you deduct these if they don't qualify for the credit? Well, it seems to be about fairness, preventing a total loss of any tax relief, even if it's not the best kind of relief. For instance, this includes things like taxes tied to specific anti-boycott rules. If you've been involved in activities the U.S. sees as part of an international boycott, related foreign taxes might not be creditable, but may be deductible.
Okay, so policy reasons sometimes override the credit. What else?
Taxes paid to certain sanctioned countries. The Treasury Department has a list of countries supporting terrorism, or those the U.S. doesn't have diplomatic relations with. Taxes paid directly to those governments. Generally not creditable. But you might still be able to deduct them. It prevents a complete loss of recognition for that tax payment.
Right. Sanctioned countries, that makes sense. Anything else common?
Yeah, taxes where you didn't meet specific holding period requirements. This trips up investors sometimes. For example, you get foreign dividends, but you didn't hold the stock long enough, maybe at the required 16 days within a 31-day window around the ex-dividend date. The foreign withholding tax on that dividend, suddenly non-creditable. But you could potentially deduct it. It's designed to stop tax arbitrage games.
Ah, the holding period trap. Good one to know.
Then there are taxes involving related payments. If you get income, like a dividend, but you're also obligated to make basically an equivalent payment to someone else on similar property, the foreign withholding tax isn't creditable. Again, targeting complex financial setups. May be deductible, though. Certain oil or gas taxes, too. If you pay taxes related to buying or selling foreign oil gas and you don't have an economic interest or the price isn't fair market value, usually not creditable. Might be deductible. Taxes linked to covered asset acquisitions. These are complex rules under Section 901 meter, stopping a double benefit when asset buys give you a stepped-up basis for U.S. tax. Also, foreign taxes disallowed under Section 965G. That relates back to the repatriation tax rules. And critically, interest or penalties. You can never credit foreign interest or penalties you paid. Never. These are only deductible maybe as business expenses, but not as foreign income taxes.
Wow, okay. That's quite a list.
And one more. If you're an accrual basis taxpayer and you previously chose to deduct foreign taxes in a prior year, any taxes paid now that relate back to that prior deduction year can also be deducted, even if you're claiming the credit for this year's taxes. So yeah, while the credit's usually the way to go, these specific exceptions show that even a deduction gives you some relief. Better than nothing, right? And understanding them is a key tax-saving nuance.
That is a comprehensive list of exceptions. Really shows how intricate tax law gets. Okay, so once you make this fundamental choice, credit or deduction, are you locked in forever? Or is there some wiggle room? Can you change your mind later if, say, circumstances change, or you just realize you picked the wrong path initially?
This is where the IRS actually provides a significant level of flexibility, which is really critical for planning and, let's be honest, for fixing past mistakes sometimes. You have a special, quite generous 10-year limitation period. It's defined under Section 6511 DT3. This lets you elect to claim a foreign tax credit if you initially took a deduction. So if you realize maybe years down the line, wow, claiming the credit would have saved me way more money, you likely still have time to amend that old return and claim the credit instead. It's almost like a tax do-over, but just for this specific choice.
A 10-year window. That is substantial. What about going the other way? If you claimed a credit first, but then for some reason decide the deduction would have actually been better.
Right. Conversely, changing from a credit back to a deduction follows the standard, much shorter 3-year limitation period. That's under Section 6511A. So the flexibility is there for both directions, yes, but the window is much, much wider if you're looking to switch to the credit. This difference in the time limits really underlines how much the U.S. tax system prefers the credit as the primary way to handle double taxation. But that flexibility is still a powerful tool if your financial picture or even just your understanding of the rules changes over time.
Okay, moving on. At its heart, Form 1116 is for individuals, estates, or trusts claiming the foreign tax credit. But let's clarify who absolutely must wrestle with this form and, maybe more excitingly, who gets to skip it entirely. That sounds like it could simplify tax life and still save money. That sounds like a true tax-saving gem right there.
Precisely. Yeah, Form 1116 is the standard vehicle, the main road, if you've paid or accrued certain foreign taxes and you want that credit. It's the detailed roadmap for those calculations. However, and this is really a significant simplification for many people, the IRS does allow some taxpayers to claim the foreign tax credit without filing Form 1116 at all. This isn't just about saving dollars. It's about saving time, reducing complexity, maybe avoiding some headaches during tax season.
Okay, my ears definitely perked up at skip the form. Tell us more about the selection. Claiming the credit without filing Form 1116, what are the specific, maybe magic conditions you need to meet to unlock this simplification?
This is where it gets really interesting for a lot of people, especially those with relatively straightforward international investments, like dividends or interest. You might be able to make this election if you meet all of these conditions. Has to be all three. 1. Passive income only. All your foreign source gross income has to be categorized as passive category income. Mostly, this means interest and dividends. It's really designed for investment income, not active business income like wages or self-employment earnings. Though for this specific election, passive income also includes certain export financing interest, and even that high-taxed income we mentioned earlier, which normally gets reclassified. For this small exception, it stays passive.
Okay, passive income only. Got it. What's number 2?
2. Qualified pay statements. All this income, and importantly, any foreign taxes paid on it, must be reported to you on official simplified pay statements. We're talking about forms like Form 1099, Ds Andy 9, Ds for dividends, Form 1099 INT for interest, or maybe a Schedule K1 or K3 from a partnership or S-Corp you're invested in. This basically ensures the information is easily verifiable and streamlined for the IRS. It's why they allow this simplification. The data is already neatly packaged.
Makes sense. And the third condition?
3. Small amount of tax. Your total credible foreign taxes for the year must not exceed a pretty low threshold. $300 if you're filing a single, head of household, or married filing separately. If you're married filing a joint return, that threshold doubles to $600. This keeps the election targeted at smaller, less complex foreign tax situations. It prevents the need for the full complexity of Form 1116 if you just have a little bit of foreign tax.
That sounds like a huge sigh of relief for many people. So if you meet all 3 conditions, what are the direct benefits? And are there any catches or trade-offs we need to be aware of?
The primary benefit, and why it's such a valuable simplification, is that the foreign tax credit limitation, that complex calculation in Part 3 of Form 1116 that makes sure you don't use foreign taxes to offset U.S. tax on U.S. income while it just won't apply to you, this cuts out a significant chunk of calculation, a major headache.
Okay, no complex limitation calculation. That's huge. What are the catches?
There are a few catches, yeah. Trade-offs for the simplicity. First, no carryovers. You cannot carry over any unused foreign taxes to or from other years. So if your creditable foreign taxes happen to exceed your U.S. tax liability in that specific year, any excess credit is just lost, gone. That's the biggest trade-off. Second, creditable taxes still required. You still have to make sure the taxes you're claiming are generally creditable, meaning they weren't taxes you didn't legally owe to the foreign country or taxes that fall into those ineligible categories we talked about earlier. The simplification doesn't make non-creditable taxes suddenly creditable. And third, reduction for excluded income. You still have to reduce your claimable taxes by any amount that relates to foreign income you excluded, maybe using Form 2555. You can't claim a credit for taxes on income you've already excluded from U.S. tax.
Okay, so some limitations, but still a big simplification. How do you actually make this election if you qualify?
It's actually really simple. You just enter the smaller of your total creditable foreign tax or your regular U.S. tax liability directly onto the foreign tax credit line of your main tax return. That's usually Schedule 3, Form 1040, Part 1, Line 1, no Form 1116 needed. It's a fantastic way to save both money and significant time and hassle if you fit those criteria.
That's a great practical tip. Beyond this no Form 1116 election, are there other unique situations or specific taxpayer types that might affect who files Form 1116 or maybe how it interacts with other tax forms?
Absolutely. There are a few other specific scenarios. For instance, if you're a non-resident alien, you generally cannot take the foreign tax credit at all. There are very narrow exceptions, like if you've been a bona fide resident of Puerto Rico for the entire tax year, or if you're paying foreign tax on income that's effectively connected with a U.S. trade or business. Even then, if that foreign tax is imposed only because you're a citizen or resident of that foreign country, it typically isn't creditable against the U.S. tax on that U.S.-connected income. Complex rules there.
Okay, non-resident aliens usually out. What about U.S. territories?
Right. A critical nuance for those with ties to U.S. territories. Don't use Form 1116 for taxes paid specifically to the U.S. Virgin Islands. For the USVI, there's a different form, Form 8689, allocation of individual income tax to the U.S. Virgin Islands. It's designed for that particular tax relationship. Other territories generally fall under Form 1116 rules, though.
Good distinction. And what about other forms? Does Form 1116 ever bring along, companions to the tax filing party?
Yes, it often travels with friends, you could say. If you have foreign tax credits you couldn't use in the current year, those prior year foreign tax carryovers, or if you generate new ones this year that you need to carry forward, you'll definitely need Schedule B, Form 1116. That's the foreign tax carryover reconciliation schedule. It's basically like a logbook for your unused credits. And for any foreign tax redeterminations, which we'll get into next, when a foreign tax liability changes after you've filed Schedule C, Form 1116 becomes essential for reporting those prior year changes. Lastly, if you're dealing with contested foreign income taxes, meaning the amount is still under dispute with the foreign government, but you've maybe already paid it, Form 7204 comes into play. You use that to elect a provisional credit, which can be a really valuable cash flow management tool. These additional forms and schedules, they're all designed to ensure accurate tracking and reporting, which again is all about correctly claiming your tax savings and staying compliant.
Okay, this seems like the most fundamental question, doesn't it? What foreign taxes actually count? What does the IRS consider creditable when we're trying to slice down our U.S. tax bill?
You're right, this is absolutely core. The eligibility criteria are quite specific, but they're designed to be broad enough to capture genuine income tax burdens you face overseas. You can take a credit for income taxes, war profits taxes, and excess profits taxes that you paid or accrued during your tax year. This can be to any foreign country or any U.S. territory, or even to any political subdivision, like a province or a city within that country or territory. And this also includes taxes paid or accrued in lieu of such a tax. That's an important phrase. It means if a foreign country imposes a tax that basically serves the same purpose as a general income tax, even if it's called something different, maybe a royalty tax that functions just like an income tax based on net profits, it can still be creditable. U.S. territories for this purpose, we're talking Puerto Rico, the U.S. Virgin Islands, the remember Form 8689 for 6 taxes, Guam, the Northern Mariana Islands, and American Samoa. What's kind of fascinating here is that the IRS's own big guide, Publication 514, the Foreign Tax Credit Guide, it even details an additional credit possibility for U.S. citizens living in certain treaty countries, specifically for foreign tax imposed on U.S. source income. This is a really nuanced point, designed proactively to address situations where a tax treaty aims to prevent double taxation, even if the income technically originated in the U.S. but got taxed abroad because of treaty rules.
Equally important, then, has to be knowing what doesn't count. What are some of the common traps or situations where a foreign tax you've paid might not be creditable against your U.S. tax, even if it feels like a legitimate tax payment to you?
This brings up that important question again. Why would a foreign tax not be creditable, even if you clearly paid it? Well, it's often to prevent abuse, or to ensure the credit is only for legitimate, unavoidable foreign income taxes, or sometimes just to align with broader U.S. policy. Here's a critical list of taxes you generally cannot credit. Understanding these is vital to avoid wasting time or, worse, facing IRS issues. Number 1. Taxes not legally owed. This is foundational. If you didn't actually legally owe the foreign tax, including any amounts that were eligible for a refund from the foreign country, you cannot credit it, period. The instructions give a really clear example. If country X withholds $25 but a tax treaty says you only owe $15, then only $15 is credible. It doesn't matter if you apply for the $10 refund or not. The IRS says you must exercise available remedies to reduce the tax to what is genuinely and legally owed. The credit is only for your unavoidable tax burden.
Okay, so you have to pursue refunds if they're available. Makes sense. What else?
Taxes offset by foreign tax credits. If the foreign tax itself was reduced or wiped out by a foreign tax credit in the foreign country, basically, if you got a foreign credit for it over there, you generally can't claim a U.S. credit for that same amount. Prevents a credit for a credit situation unless that foreign credit was fully refundable to you in cash without first offsetting your foreign tax liability. Taxes imposed solely due to U.S. credit. Some foreign countries might, theoretically, impose a tax only because they know you can turn around and claim a U.S. foreign tax credit for it. These kinds of taxes are specifically not creditable. It stops circular tax arrangements designed just to generate a U.S. credit without a real underlying foreign tax burden.
Okay, anti-abuse rules. What about the political side?
Taxes to sanctioned countries. As we touched on, taxes paid to countries designated by the Secretary of State as supporting terrorism, or those the U.S. lacks diplomatic relations with, typically not creditable. Pub 514 lists them. But remember that nuance. If you're a U.S. citizen living in a non-sanctioned country, say country A, and country A taxes your income that you derived from a sanctioned country, say country B, maybe you have a branch there, those taxes paid to non-sanctioned country A are eligible for the credit. It's about who you pay the tax to. There's also presidential waiver authority here, showing that blend of tax and foreign policy.
Right, the payment destination matters. What about investment-related exclusions?
Holding period violations. This one catches a lot of investors. Foreign taxes withheld on dividends or maybe other income or gain from property are not creditable if you haven't held the underlying stock or property for a minimum period. For dividends, it's typically at least 16 days within a 31-day window surrounding the ex-dividend date or payment date. This stops people from just jumping in and out of stocks quickly solely to grab foreign tax credits.
Right.
Related payments, if you have to make related payments on positions in substantially similar property, like you get a dividend but you're obligated to pay an equivalent amount to someone else, you can't claim the credit for the withholding tax on those dividends, again targeting potentially abusive transactions. Subsidies. Foreign taxes that are used directly or indirectly to provide a subsidy back to you or a related party or someone you transact with are not creditable. The credit is for genuine tax burdens, not for amounts that effectively circle back to you as a benefit.
Okay, no credits for subsidized taxes. Any others?
A few more technical ones. Certain oil gas taxes, as we mentioned, if you don't have an economic interest or the price isn't fair market value. Excluded income on Form 8873, extraterritorial income exclusion. Taxes on income you excluded generally can't be credited. Covered asset acquisitions, Section 901 water. The disqualified part of foreign tax related to acquisitions that give you a stepped-up basis for U.S. tax. Prevents a double tax benefit. Section 965G. Disallowed taxes related to the transition tax. And finally, again, interest or penalties. Absolutely cannot take a credit for any interest or penalties paid to a foreign tax authority. The credit is strictly for income taxes, not for charges due to non-compliance or late payment.
Understanding these exclusions is clearly just as crucial as knowing what qualifies. It helps avoid pitfalls, get the creditable amount right, and maybe shift some non-creditable taxes over to the deduction side, if that's allowed, really maximizing your overall tax benefit.
Exactly. It's about navigating the rules correctly.
Okay, let's talk currency. With global income, obviously, comes global currency. This is where things can get a bit tricky for many people, I think. How do you accurately handle converting all those foreign taxes paid in, euros or yen or pesos into U.S. dollars for the Form 1116? Does it matter which exchange rate you use?
Oh, it absolutely matters, yes. And it's a common point of confusion. All amounts on Form 1116 generally have to be reported in U.S. dollars. Now, for taxes that were actually paid, the conversion rate you absolutely must use is the rate of exchange that was in effect on the exact day you paid the foreign taxes. Or, if it was withheld, the day the tax was withheld. This is a very specific date requirement, not some general average for the month or year. Think of it like this. If you paid a tax installment on March 15th, you use the March 15th exchange rate. If tax was withheld from your dividend on July 1st, you use the July 1st rate for that withholding.
What if you get a refund of foreign taxes later on? Does that change things? Do you use the rate when you receive the refund or stick with the original payment rate?
That's a crucial distinction, and you stick with the original rate. If you receive a refund of foreign taxes in a later year, you must use the conversion rate that was in effect when you originally paid those taxes, not the rate when you received the refund. This prevents you from getting a tax benefit or a detriment just because the currency fluctuated between the time you paid and the time you got the refund back. It ensures the credit accurately reflects the original tax burden in dollar terms and avoids potential arbitrage games based purely on currency swings.
Okay, that makes sense for taxes actually paid. Use the payment date rate. But what if taxes are accrued rather than paid? Maybe you're an accrual basis taxpayer, or you're a cash basis person who elected to claim the credit for accrued taxes. And are there any special elections for currency conversion that might simplify things?
Right, for taxes that you accrue but haven't actually paid yet, which applies mainly to accrual basis taxpayers or those cash basis folks who specifically make that election we discussed, you're generally required to use the average exchange rate for the tax year. This offers a bit more flexibility, maybe simplifies things compared to tracking daily rates for accruals. However, there's also a valuable election available specifically for accrued taxes. It can be really helpful if you're dealing with many transactions during the year. If the accrued taxes are denominated in what's called a non-functional foreign currency, you can elect to use the exchange rate in effect on the date the foreign taxes are actually paid, even if you're otherwise accruing them for credit purposes. This election applies to the year it's made and all subsequent tax years unless you get IRS consent to revoke it. It provides some planning certainty and can simplify calculations by letting you use a known paid date rate instead of estimating an average rate. Also, just a note,
For any accrued taxes that are still unpaid at year end, those must be translated into U.S. dollars using the exchange rate on the last day of the U.S. tax year to which they relate. And one final point for those with more complex foreign operations. If you operate what's called a qualified business unit, or QBU, in a foreign country, basically a separate business unit keeping its books in a foreign currency, there are special, more complex rules for converting both the income and the taxes into U.S. dollars. Publication 514 details those. They're designed to accurately reflect the financial reality of those foreign operations for U.S. tax.
Okay, taxes aren't always a one-and-done deal, right? Especially when dealing internationally. What happens if your foreign tax liability actually changes after you've already filed your U.S. return? Maybe you get an unexpected refund from abroad, or perhaps a foreign government audits you and says you owe more tax for a past year.
Yeah, this is a critical area for ongoing compliance, and frankly, neglecting it can lead to significant penalties down the road. We call this situation a foreign tax redetermination. It occurs whenever there's a change to your foreign tax liability for a prior year. This could be a refund of taxes you previously claimed a credit for, or it could be an increase in taxes due to a foreign audit finding you owe more. Or maybe a foreign tax assessment or payment changes a prior year's foreign tax credit calculation. It can even include changing your mind about claiming a credit versus a deduction for a prior year, or certain changes related to controlled foreign corporations, or even just significant exchange rate fluctuations between when you accrued a tax and when you actually paid it if you're on the accrual basis.
So basically, any change to that past foreign tax liability means I might have to reevaluate my U.S. credit for that year. Is there a point where the change is so small, maybe just currency fluctuation, that I don't have to go through all this hassle?
Yes. Thankfully, there is a practical de minimis exception specifically for small exchange rate fluctuations. No redetermination reporting is required if the change in foreign tax liability for a specific foreign country is solely due to exchange rate changes, and it's less than the smaller of $10,000, or 2% of the total dollar amount of the foreign tax initially accrued for that country for that U.S. tax year. In those small cases, you can often just adjust your U.S. tax liability in the current year when the taxes are finally paid, rather than having to go back and amend a prior return. It's a welcome simplification for minor currency-driven changes.
That's helpful to know, but if a redetermination does occur and it's significant, or not just currency related, what's the IRS expecting from us? What's the reporting requirement then?
Right, if a foreign tax redetermination changes the amount of U.S. tax due for any past tax year, you generally must file Form 1040-X, the amended U.S. individual income tax return, or whatever other amended return is appropriate, to notify the IRS. You need to attach a revised Form 1116 for the affected year, or years, and also include a statement that provides enough information for the IRS to understand and redetermine your U.S. tax liability. Now, if the redetermination results in an increase in your U.S. tax, maybe you got a foreign refund, so your U.S. credit is now lower and you owe more U.S. tax, you should specifically know something like, this amended return and Form 1116 are for a change in foreign tax credit that increases U.S. tax liability in the explanation part of Form 1040-X. This notification is absolutely crucial because the usual statute of limitations for the IRS to assess more tax typically does not apply to increases that result from foreign tax redeterminations. This means the IRS can potentially come back for that increased tax even many years later if you don't report it properly.
Wow. Okay, so the statute of limitations doesn't protect you there. What if the change actually doesn't alter my U.S. tax liability? Maybe the change was small, or it was offset by other factors in the calculation. Do I still need to tell the IRS?
Yes, generally you do. Even if the redetermination doesn't change your U.S. tax liability for that prior year, you still usually need to notify the IRS. You typically do this by attaching a completed Schedule C, Form 1116, Foreign Tax Redetermination Schedule, to your current year tax return. This schedule summarizes the redeterminations that occurred during the current year but relate back to prior tax years. This meticulous reporting ensures the IRS has a full and accurate picture of your foreign tax situation over time. It helps prevent future issues or questions, even if there was no immediate tax impact.
What if a foreign tax is still being debated, contested with the foreign government? Can you claim a credit for it then, even if it's not a final, agreed-upon amount? That sounds like it could tie up your potential credit for years while you argue.
You've hit on a common dilemma, yeah. Generally, the rule is no. You cannot claim a credit for a contested foreign income tax liability until the contest is fully resolved, the amount is finally determined, and you've actually paid it. However, this raises that important practical question. What if you've already had to remit the money to the foreign country as a provisional payment, or maybe post a bond, just to continue the contest? The money's out of your pocket, but the liability isn't final. What then? That's where the election to claim a provisional credit for contested taxes comes in. And it's a really valuable tool for cash flow management in these situations.
A provisional credit. That sounds like a potential lifeline for businesses or individuals stuck in long foreign tax disputes with significant money involved. How does that election work?
It allows you, whether you're on a cash or accrual basis for tax generally, to claim a credit for that contested foreign income tax liability in the tax year you actually pay the contested amount to the foreign country. You can claim it even if the liability isn't final yet. To make this election, you must file Form 1116 for the year the contested liability is paid. You also need to file Form 7204, consent to extend the time to assess tax related to contested foreign income taxes. This form basically gives the IRS more time to come back and adjust things once the contest is finally resolved. Then you have to annually file Schedule C, Form 1116, for each subsequent year until the contest is settled, keeping the IRS updated. This whole process helps avoid potentially significant cash flow issues, lets you claim the credit much sooner rather than waiting possibly years for the dispute to end. It's a very pragmatic solution from the IRS for these complex, drawn-out scenarios.
And what's the consequence if you simply forget? You get a foreign tax refund. Maybe it reduces your prior credit, increases your U.S. tax, but you just forget to notify the IRS about it. That seems like an easy mistake to make with everything else going on.
It's a very serious one, unfortunately, and not something to overlook. You will generally have to pay a penalty unless you can show the failure to notify the IRS was due to reasonable cause and not willful neglect. This really underscores the importance of diligent record keeping, staying on top of your foreign tax situation, and promptly addressing any changes that occur, especially refunds. It's not just about getting your credit right in the first place. It's about maintaining compliance over time to avoid additional financial burdens, penalties, and potential audits down the line. It's a powerful reminder that while the foreign tax credit offers great savings potential, it definitely comes with ongoing responsibilities.
Okay, switching gears slightly. Before we even really get into the mechanics of filling out Form 1116, we need to know what actually counts as foreign source income in the first place.
Right.
That seems like step 0.
Absolutely. Figuring out whether your income is U.S. source or foreign source is the very first foundational step. If the income isn't foreign source, it generally can't support a foreign tax credit claim. Foreign source income generally includes, but isn't limited to, common things like interest income from a payer located outside the United States, dividends from a corporation that's incorporated outside the U.S., also certain complex inclusions like Subpart F income in Section 951A or GILTI, inclusions from controlled foreign corporations you own, basically, certain types of passive or deemed income from foreign entities. It can also include gains on the sale of certain personal property, like stock, if you sold it while maintaining your tax home outside the U.S. and you paid at least a 10% foreign tax on that gain. This fundamental sourcing determination, U.S. versus foreign, dictates whether the income can even be considered for the foreign tax credit calculation.
Now, the instructions for Form 1116 mention categories of income over and over again. Why is this categorization so important? What exactly are these categories? It sounds like we can't just lump all our foreign income together in one big pot.
You're absolutely right. You cannot just lump it all together. This categorization is critical because the foreign tax credit limitation, remember, that's the maximum amount of credit you can claim, is calculated separately for different income categories. This often means you actually need to complete a separate Form 1116 for each category of foreign income you have, which, yes, adds to the complexity, but it's designed that way to prevent abuse and ensure fairness.
And why is that separate calculation so important? What's the IRS trying to prevent by making us use separate forms or categories?
It's designed primarily to prevent taxpayers from using excess credits from high-tax foreign income in one category to improperly offset U.S. tax on low-taxed foreign income in another category. Imagine if you had some foreign income tax at, say, 50% abroad in one business line and other foreign income tax at only 5% from passive investments. Without separate categories, you could potentially blend them, and the high tax from the coast might let you completely avoid U.S. tax on the lightly taxed second income stream. The separate limitation rules essentially say, hold on, you can only use foreign taxes paid on passive income to offset U.S. tax on passive income. You can only use taxes on general category income to offset U.S. tax on general category income. It's like having separate buckets, each with its own specific foreign tax credit limit based on the U.S. tax attributable to the income in that bucket.
Okay, separate buckets. What are the main buckets, the main categories we need to know about?
The main categories you'll likely encounter are 1. Passive category income. This is a broad category. Typically includes most interest, dividends, royalties, rents, annuities, net gains from certain property sales. However, it's not entirely straightforward. It specifically excludes certain things like export financing interest, active business rents and royalties, and critically, high-taxed income. High-tax income is passive income, where the foreign taxes you paid on it, after allocating expenses, actually exceed the highest U.S. individual tax rate. If income gets tagged as high tax, it gets kicked out of the passive category and usually reclassified into the general category. This prevents you from using really high taxes on some passive income to generate large unused credits that could then shelter other low-tax passive income from U.S. tax through carryovers. It also excludes financial services income if you happen to be a financial services entity.
Okay, passive is bucket one. With that high taxed exception, what's next?
2. General category income. This is basically the catch-all bucket for most active business income that doesn't fit into other specific categories. It typically includes wages, salary, and any overseas allowances you earn as an employee working abroad. Income from an active trade or business you conduct overseas, like through a foreign branch, and gains from selling inventory or depreciable property used in that business. Most earned income from working abroad usually falls here.
Got it. General category for active income. Any others?
3. Section 901J income. This relates to income derived from specific sanctioned countries. As we discussed, taxes paid directly to these sanctioned countries generally aren't creditable. You have to use a separate Form 1116 for each such country, and you only complete it partway through, basically calculating the income but not claiming a credit. But remember that nuance. If you paid taxes to a non-sanctioned country on income derived from a sanctioned country, like our example of country A taxing income from your branch and sanctioned country B, those taxes paid to country A are eligible for the credit. 4. Certain income resourced by treaty. This can be a powerful category. If a U.S. tax treaty allows income that would normally be U.S. source to be treated as foreign source, and you elect to apply that treaty provision, that resourced income becomes its own separate category. This often requires a separate Form 1116 and potentially filing Form 8833, Treaty-Based Return Position Disclosure, as a key tool under treaties to prevent double taxation when the treaty overrides standard sourcing rules. 5. Lump sum distributions. There are special rules if you take a foreign tax credit for taxes paid on a foreign source lump sum distribution from a pension plan. This is a very specific category with its own calculation methods, often involving special formulas found in Publication 575.
Okay, understanding these categories is clearly the compass for navigating Form 1116. They dictate how income and taxes get grouped, and ultimately how that crucial credit limitation is applied to each group.
Exactly. Get the category wrong and your limitation calculation will be off.
What about folks who are partners in a partnership or maybe shareholders in an S corporation? How does their foreign income and tax flow through to them for Form 1116? What do they need to look out for? It's not their direct income, right?
Right, it flows through. And this is where Schedule K3 becomes absolutely invaluable. Schedule K3, Form 165 for partnerships, Form 1120S for S Corp, is specifically designed to report the necessary foreign tax information to the partners or shareholders. For instance, if you're just a limited partner with less than a 10% interest by value in the partnership, your share of the partnership's foreign source income and deductions is generally categorized as passive income for you. You essentially take the amounts reported on your Schedule K3, the foreign income, the allocated deductions, the foreign taxes paid or accrued, and you incorporate them into your own Form 1116. You'll often need to use a separate Form 1116 for each income category reported on the K3, and sometimes even use separate columns or lines within a single Form 1116 for different countries or income types, following how the K3 presents the information. Some income types reported on K3, like gains from selling certain property, might still require you to determine if it's U.S. or foreign source based on your residency and tax home before you put it on Form 1116. The K3 provides the raw data. The key here is that the character, passive, general, etc., and the source, U.S. foreign, of the income and taxes are properly maintained as they flow through from the entity level to your individual return. This ensures you apply the correct foreign tax credit rules and limitations to income that isn't directly earned by you but comes through an entity you own. The K3 is the bridge.
All right, let's get into the real nitty-gritty of the form itself. We've talked about the big picture, the core concepts, the categories. Now, for those who actually need to fill out Form 1116, let's go part by part. Shine a light on what's important in each section and how to approach it strategically, especially thinking about tax savings. Let's start with part 1. That's all about your foreign income and the related deductions, right? Where do we begin there?
Exactly. Part 9 is foundational. It's where you build the specific foreign taxable income figure for each separate income category you're claiming the credit for. Think of it as painting that clear financial picture of your foreign operations or investments for the IRS for that specific category. First up, lines 1A and 1B, foreign gross income. On line 1A, you'll enter the gross income from foreign sources that falls into the specific category you checked at the very top of the form. You should also identify the type of income. Just write dividends, wages, business income, etc. It's important to include income here that's taxable by the U.S., even if the foreign country itself didn't actually tax it. The U.S. still considers it foreign source income for the limitation calculation. Now, a crucial point for maximizing your credit potential and avoiding double dipping: do not include on line 1A any earned income that you've already chosen to exclude from U.S. tax using Form 2555, the Foreign Earned Income Exclusion. You can't claim a credit for taxes paid on income you've already opted out of U.S. taxation for. That's a definite no-no. Line 1B is a special checkbox, mainly for certain high-earning employees who might use an alternative documented basis to source their compensation between U.S. and foreign sources. Most people skip 1B.
Okay, so line 1A is foreign gross income for the category minus any excluded income. Then come the deductions, lines 2 through 5. How do we handle reducing that foreign gross income?
Right, this is where you allocate deductions and losses to reduce that foreign gross income down to foreign taxable income. Properly doing this is vital because a higher foreign taxable income, line 7, generally leads to a higher foreign tax credit limitation, part 3, meaning you can potentially claim more of your foreign taxes as a credit. Line 2 is for deductions that are definitely related directly to your foreign income in this category. Think business expenses specifically for a foreign business you operate in this category, or maybe state and local income taxes that are directly traceable to this specific foreign source income. Don't put interest expense here, though. That has its own lines later. Lines 3A and 3B are for deductions that don't clearly relate specifically to either foreign or U.S. source income. These are the ones you generally have to apportion. Line 3A includes certain itemized deductions like medical expenses, general sales taxes if you claim those instead of state income tax, real estate taxes on your personal home, or if you don't itemize, a portion of your standard deduction goes here.
Line 3B is for other deductions that aren't itemized but still need apportionment, like those found on Schedule 1, Form 1040, Part 2, things like student loan interest, IRA deductions, self-employment tax deduction, etc. You have to attach a statement listing these out. A key reminder here. The deduction for state and local taxes, SL, on your Schedule A is generally capped at $10,000, $5,000 if married filing separately. Make sure the amount you allocate here on Form 1116 doesn't contribute to exceeding that overall cap on your return.
Okay, so direct deductions on line 2, apportioned ones on lines 3A, 3B. How do we figure out the apportionment part? That sounds crucial.
It is. And that's where lines 3, 3E, and 3F come in. They're vital for figuring out the proportion of those general deductions that gets allocated against your foreign income. Line 3 is your gross foreign source income from the specific category you're working on. Importantly, for this calculation only, you include any Form 25505 excluded income here, but no other exempt income. Line 3 is your total gross income from all sources and all categories, both U.S. and foreign. This total gross income amount will be the same across all the different Forms 1116 you might file for different categories. If you had to make adjustments later for foreign qualified dividends or capital gains, we'll get to that, you include the unadjusted amounts here on 3rd and 3E. Line 3A is simply the ratio, line 3 divided by line 3E. You round this to at least 4 decimal places, but it can't be more than 1.0000. This ratio is then used to multiply against the deductions on lines 3A and 3B, and some interest later, to determine the portion allocated to foreign sources.
Got it. Ratio based on gross income. What about interest expense? You said it has its own lines.
Yes. Lines 4A and 4B handle interest expense, and there's a specific ordering. First, there's a small but potentially helpful tax-saving simplification here. If your total gross foreign source income from all categories, and including any Form 25 and 55 excluded income, is $5,000 or less, you can elect to allocate all of your interest expense to U.S. source income. This significantly simplifies the interest allocation calculation and can be a small tax-saving win because it preserves your foreign source income, doesn't reduce it, potentially allowing for a slightly larger credit limitation. If you don't qualify for that small exception, then deductible home mortgage interest, line 4A, is generally apportioned using that same gross income ratio from line 3F. Other deductible interest expenses, line 4B, like investment interest or maybe certain business interest, are usually apportioned using a different method called the asset method. Here, the interest is allocated based on the relative tax basis, usually adjusted basis, of your U.S. assets versus your foreign assets. This is more complex and often requires tracking asset values. Pub 514 has details. For example, if your calculations show $1,200 of your investment interest is allocable to foreign source assets, that $1,200 goes on line 4B.
Okay, asset method for other interest. And line 5, capital losses.
Right. Line 5 is for foreign source capital losses allocated to this income category. But, as hinted before, if you have foreign source capital gains or losses, you'll likely need to refer to the complex rules and worksheets for foreign qualified dividends and capital gains losses to make required adjustments before entering any loss amount here. They don't just go in at face value.
It seems some specific income types have unique reporting requirements within Part I too. You mentioned things like Section 863B, income.
Yes, these are basically specialized ways to categorize or group certain income types within Part 1, often to streamline reporting or adhere to specific legislative treatments. For instance, Section 863B, income. This is income that's considered partly from U.S. sources and partly from foreign sources under special rules. Think certain services performed partly outside the U.S., or sales of inventory produced domestically but told abroad. You don't report this per country within Part 1. Instead, you total it up in a single column in Part I and write 863B on line I, the country code line. Similar treatment applies to regulated investment company, RIC, pass-through amounts. If you get foreign income and taxes passed through from mutual funds or other RICs, reported usually on Form 1099 DIV, you total the income and foreign taxes passed through in a single column and just write RIC on line I. Section 951A inclusions, GILTI. These also go into a single column with 951A written on line I. And finally, high-taxed income, HTKO. Remember that passive income that gets reclassified because the foreign tax was too high? It requires its own separate column labeled HTKO on line I. This reclassified income will actually appear as a positive number in the HTKO column of the Form 1116 for the category it got moved to, usually general, and as a negative number in the HTKO column of the Form 1116 for the passive income category it came from. This ensures the overall calculation correctly reflects its reclassification and applies the separate limitation rules properly.
Okay, that makes sense. Part 1 sets the stage by defining the foreign taxable income for each category. Now let's move to Part 2, foreign taxes paid or accrued. What goes in here?
Right. Part 2 is where you list the actual foreign income, war profits, or excess profits taxes you've paid or accrued during the year that relate specifically to the income category you checked at the top of this particular Form 1116. You generally need to enter the amounts in both the foreign currency and their U.S. dollar equivalent, using those specific currency conversion rules we talked about, usually the rate on the date of payment or withholding. Now, if a single foreign tax payment you made actually relates to income in more than one category, maybe a general income tax applies to both your business profits and your passive investments, you must apportion that single tax payment among the relevant categories. This is typically done based on the ratio of net foreign taxable income you calculated in Part I for each category that the tax applies to. You can't just dump the whole tax into one category if it covered income in others.
And you mentioned a key choice here earlier, cash versus accrual for claiming the credit.
Yes. This is a key strategic choice you make in Part 2, particularly if you're normally a cash-basis taxpayer. You generally take the credit in the year you either paid or accrued the foreign taxes, depending on your overall accounting method, cash or accrual. However, if you're on the cash basis, you can choose to take the credit for foreign taxes in the year they are accrued, even if you haven't paid them yet. You make this choice by checking the accrued box in Part 2 on a timely filed original return. Critically, this choice, once made, is binding for all future tax returns. You can't switch back and forth year to year without IRS permission. Why might this be advantageous for tax savings or cash flow? It can allow you to claim the credit sooner. For instance, if a large foreign tax liability is assessed and accrued late in year 1, but you don't actually pay it until early year 2, electing the accrual method lets you claim the credit on your year 1 return, potentially lowering your year 1 tax bill or increasing your refund sooner.
Okay, that accrual election sounds powerful for timing. Are there any other special entries or things to note in Part 2?
Couple of things. If you have taxes that were previously suspended under Section 909, maybe because the related income wasn't recognized for U.S. tax purposes in the year the tax was paid, like with certain foreign entities, but those taxes are now allowed because the income is finally being taken into account, you enter those amounts and specifically note 909 taxes in column nil. Also, a nice simplification. If foreign tax paid on passive income, like dividends or interest, is reported directly to you in U.S. dollars on a Form 1099 DIV or 1099 INT from your broker, you generally don't need to worry about the foreign currency amount or the conversion rate. You can simply enter 1099 taxes in column and fill in the relevant U.S. dollar columns based on the 1099. And finally, if you're dealing with additional taxes paid due to a foreign audit for a prior year, or maybe reporting a foreign tax refund received that relates to a prior year, you must attach a statement to your Form 1116 that clearly identifies these specific taxes being claimed or adjusted in Part 2.
Okay, this is it. Part 3, figuring the credit. This feels like the section where all the calculations really come together to determine your actual foreign tax credit, the real tax savings number. Let's break down the most impactful lines and concepts here, especially focusing on tax savings and understanding the true power and limits of this form.
You got it. Part 3 is absolutely where the rubber meets the road. It's where the crucial foreign tax credit limitation is calculated and applied. This limitation is fundamentally designed to ensure you don't use foreign taxes paid on foreign income to reduce your U.S. tax liability on your U.S. source income. Without this limit, you could theoretically pay very high foreign taxes and potentially wipe out your entire U.S. tax bill, even on domestic earnings. The limit prevents that, capping your credit at the amount of U.S. tax attributable to your foreign source income. This is why getting the calculations right in Parts 1 and 3 is so important for maximizing your allowable credit.
Makes sense. So what are the key lines or concepts in Part 3 we should focus on for tax savings or just understanding the mechanics?
Let's highlight a few critical ones. Line 10, unused foreign taxes. Carry back, carry forward. This is really critical tax-saving mechanism. It's a true lifeline if you have high foreign taxes in 1 year, but maybe not enough U.S. tax on foreign income to use them all. If the foreign taxes you paid or accrued for a specific category after the reductions on line 12 exceed the U.S. tax limitation calculated for that same category in the current year, you haven't necessarily lost that excess credit. You can generally carry back the excess amount 1 year, then carry it forward up to 10 years. This allows you to utilize otherwise wasted foreign tax credits from a high tax year in a different year where you might have had lower foreign tax but higher U.S. tax liability on foreign income. Think of it like a credit bank. If you overpaid your foreign taxes relative to your U.S. limit this year, you can potentially pull credits from last year, the carry back, or save the excess to use over the next decade, the carry forward. You'll use Schedule B, Form 1116, to meticulously track these carryovers. A key restriction, though:
You cannot carry a credit back to a year for which you chose to take a deduction, instead of a credit for that category. Also, a specific rule. No foreign tax carryovers are allowed at all for the Section 951A GLTI category income. There are also some special, sometimes complex rules for carrying forward unused foreign taxes from before the big 2018 tax law changes, allowing allocation of the post-2017 general or foreign branch categories, sometimes with a simplified safe harbor method. This carryover provision is genuinely one of the most powerful aspects of the foreign tax credit for long-term international tax planning.
That carry back, carry forward is definitely a huge benefit. What about line 12? Reductions of foreign taxes. That sounds like it could limit the credit.
It does. Line 12, reductions of foreign taxes, is crucial because it ensures you only get a credit for foreign taxes paid on income that is actually subject to U.S. tax. You must reduce the foreign taxes you listed in Part 2 by several specific items here. For example, taxes allocable to income you excluded on Form 2555, Foreign Earned Income Exclusion, must be subtracted. There's a specific formula in the instructions involving the excluded income and related expenses to figure out this reduction amount. You can't credit taxes on income you didn't pay U.S. tax on. Similarly, taxes on income from Puerto Rico or American Samoa that is exempt from U.S. tax must also be backed out here. There are also reductions related to taxes imposed on combined foreign oil and gas income, FOGEI, and taxes on foreign mineral income if you took a U.S. percentage depletion deduction for that income. Now, here's a big potential penalty. A reduction can occur if you failed to file Form 5471, the information return for U.S. persons involved with certain foreign corporations. Failure to file can reduce all foreign taxes you might otherwise credit by 10%, and potentially even more for continued failure. This is a significant penalty, clearly designed to strongly encourage compliance with foreign reporting requirements. Don't miss filing those forms. Lastly, taxes related to a foreign tax credit splitting event. Complex situations where the income and the related foreign tax are taken into account in different tax years or by different people, potentially leading to abuse, are also disallowed or reduced here.
Okay, so line 12 ensures the taxes align with taxable income. What about line 16, adjustments? That sounds complex.
It can be. Line 16 adjustments captures several complex adjustments that can significantly impact your foreign taxable income calculation. Line 15, and consequently your credit limitation. Getting these right is vital for an accurate calculation and can lead to substantial differences in your final credit. Some key adjustments include disallowed business loss, Section 461 new. This rule limiting excess business loss deductions can sometimes increase the amount of foreign income subject to the credit limitation. Allocation of foreign losses. This is important. Imagine you have a loss in one foreign income category, say a passive income loss. You must use that loss first to reduce foreign income in your other foreign income category proportionally before you can use any remaining part of that loss to reduce your U.S. source income. This process creates or increases what are called separate limitation loss accounts, SLLAs. This means in future years, if you have income in the category that originally had the loss, some of that future income will be recharacterized as income in the category that was previously offset by the loss. It ensures a loss in one foreign bucket doesn't disproportionately benefit another bucket or your U.S. income for credit purposes over time. Allocation of U.S. losses. The reverse can also happen. If you have a net loss from U.S. sources, an overall domestic loss, or ODL, a proportionate share of that U.S. loss gets allocated against your various foreign income categories, reducing your foreign source taxable income for the limitation calculation. This creates or increases overall domestic loss accounts, which also have recapture rules later. Recapture of prior year overall foreign loss accounts of FLA. Let's simplify this one. Imagine your foreign operations had a really bad year previously, generating a big loss. If that foreign loss was so large it actually reduced your U.S. taxable income in that prior year, the IRS essentially says, okay, you got a U.S. tax benefit from what was fundamentally a foreign loss. So in a later year, when your foreign income in the same category bounces back, a portion of that new foreign income gets recharacterized as U.S. source income for the limitation calculation.
This reduces your foreign tax credit limitation for the current year, effectively recapturing the prior U.S. tax benefit you got from the foreign loss. The amount recharacterized is generally the lesser of the balance in your OFLA account, or 50%, or more if you elect, of your total foreign taxable income for the year. Special, often complex rules apply if you dispose of property used predominantly in a foreign trade or business that generated an OFL. Recapture of separate limitation loss accounts, SLLA. As mentioned when allocating foreign losses, if a prior year foreign loss from Category A reduced income in Category B, then in a later year when Category A has income, some of that income must be recharacterized as Category B income. Again, this is for the limitation calculation. Note that recharacterizing the income does not recharacterize any associated foreign tax. Recapture of overall domestic loss, ODL accounts. If you had that overall domestic loss in a prior year that offset foreign source income, then in succeeding years, a portion of your U.S. source taxable income gets recharacterized as foreign source income for foreign tax credit purposes.
This effectively increases your foreign source income for the limitation calculation, potentially increasing your allowable foreign tax credit. The amount recharacterized is the smaller of your total ODL account balance, or 50% of your U.S. source taxable income with some election flexibility. These loss allocation and recapture rules are complex, but ensure the credit limitation accurately reflects long-term profitability across different income sources.
Wow, those loss rules sound like they require careful tracking year to year. Okay, moving down part 3. Line 18, taxable income from all sources. That sounds straightforward, but is it?
It's your worldwide taxable income, yes. Line 18, taxable income from all sources. It's usually your bottom line taxable income from your main tax form, like Form 1040, line 15. However, it might require specific adjustments if you have qualified dividends or capital gains taxed at preferential rates, unless you qualify for that adjustment exception we'll discuss shortly. Adjusting line 18 ensures the denominator in the limitation fraction reflects income tax at regular rates appropriately.
Okay. Line 20, U.S. income tax.
Line 20, U.S. income tax. This is your regular U.S. income tax liability against which the foreign tax credit is allowed. It generally does not include certain other taxes like the net investment income tax, NIIT, alternative minimum tax, AMT, or self-employment tax. The foreign tax credit is specifically aimed at offsetting regular income tax.
Got it. And line 22, section 960C, increase in limitation. That sounds interesting.
Line 22, section 960C, increase in limitation. This allows for a potential increase in your foreign tax credit limitation under specific, quite complex rules, usually related to certain inclusions from controlled foreign corporations, CFCs, often involving GILTI. What's potentially fascinating here for you, though maybe rare, is that if the amount calculated under these rules somehow exceeds your U.S. income tax reported on line 20, that excess amount is treated as an overpayment of tax and can actually be claimed as a refundable credit on Schedule 3, Form 1040, Part 2, line 13 RINs. So this is a situation, albeit specialized, where the foreign tax credit system could potentially result in an actual cash refund from the IRS, a powerful tax-saving opportunity for those few taxpayers who qualify.
A refundable credit. That's definitely something to be aware of if it applies.
Okay.
Bringing it home in part 3, line 24.
Line 24, maximum foreign tax credit. This is it. This is the ultimate outcome of all the calculations in Form 1116, Part 3 for this specific income category. It truly represents your actual allowable tax saving for this category for the year. It's simply the smaller of two amounts. One, the allocated amount of U.S. tax imposed on your foreign income in this category, that's the limitation you calculated, line 23, based on U.S. tax multiplied by the fraction. Foreign taxable income, worldwide taxable income. Or two, the actual amount of foreign tax paid or accrued on that income from Part 2, line 8, after the reductions you took on line 12. Whichever is smaller is your final creditable amount for this specific income category for the current year. Any foreign tax paid above this limit might be eligible for that carryback carry-forward we discussed earlier at line 10.
That was a masterclass in the engine room of Form 1116, Part 3. Now, if someone has income from multiple categories, say passive income and general category income, meaning they're filling out more than one Form 1116, how do they pull it all together at the end? Is there a master summary section?
Yes, there is. That's what Part 4 is for. Part 4, summary of credits from separate Parts 3. You only complete Part 4 on one of the Forms 1116 you're filing. Specifically, you pick the Form 1116 that has the largest amount calculated on its line 24, the maximum credit for that category. On that summary, Form 1116's Part 4, you then list the credit amounts from line 24 of all your other Forms 1116 for the other categories, on lines 25 through 31. The other Forms 1116 just get filed as attachments to your return, providing the detailed backup. But this one, Part 4, acts as the master summary, adding up all your creditable foreign taxes across all categories, line 32. There's a small exception to picking the form with the largest credit. If you're only filing for lump sum distributions, Category G, or Section 901J in Category E, you generally wouldn't use those specific Forms 1116 as your summary page unless those happen to be the only two categories you have. Finally, the very last line, line 33 of the summary in Part 4, is the smaller of your total U.S. income tax from line 20 of the summary form, or your total summarized foreign tax credit from all categories, line 32. This represents the absolute maximum total foreign tax credit you can claim against your U.S. income tax across all categories for that tax year.
Okay, that makes sense. Part 4 pulls it all together. Now, let's tackle something you've hinted at a few times. Foreign qualified dividends and capital gains losses. This sounds like a very specific and potentially quite complicated area. How do these types of income, which often get preferential tax rates in the U.S., interact with the foreign tax credit? Do they just go into part like regular foreign income?
This is indeed an area that can significantly impact your foreign tax credit calculation, and it's where the tax-saving methods really become about precision and careful calculation. No, they don't just go in like regular income, usually. If you have foreign source qualified dividends or foreign source capital gains or losses, you may be required to make certain specific adjustments to these amounts before you even factor them into your foreign gross income on line 1A or your losses on line 5 of Form 1116. The fundamental reason is exactly what you said. These types of income are often taxed at preferential. Lower rates in the U.S. think 0%, 15%, or maybe 20% tax rates, not your ordinary income tax rate. The foreign tax credit limitation calculation needs to accurately reflect that lower effective U.S. tax rate on this specific income. Without these adjustments, you might artificially inflate your foreign source taxable income relative to the actual U.S. tax imposed on that income, potentially leading to an incorrect or overstated foreign tax credit limitation. It's all about matching the credit limit to the actual U.S. tax burden on that income.
Okay, so it's about aligning the credit calculation with the actual U.S. tax burden on that specific income. Is there a way to avoid these adjustments? Maybe simplify things, especially if the amounts aren't huge? Because this sounds like it could get very complex very quickly, needing special worksheets and factors.
Yes, absolutely. And this is one of those really valuable adjustment exceptions that can genuinely simplify your tax preparation significantly. It's a clear win for saving time and avoiding complex calculations if you qualify. You qualify for this exception, meaning you can skip the adjustments if both of these requirements are met. 1. Your total taxable income doesn't exceed certain thresholds. These thresholds are tied to the income levels where the preferential capital gains rates start to phase out or shift higher. For 2023, for example, it was $383,900 if married filing jointly, or $191,950 for most others like single filers or heads of households. You need to check the instructions for the specific year. And 2, the combined total amount of your foreign source capital gain distributions plus all your foreign source qualified dividends is less than $20,000. If you meet both of these conditions, you can elect not to make these potentially complicated adjustments to your foreign source qualified dividends and capital gains.
Instead, you simply include them, without any adjustment, directly on line 1A, foreign gross income, of Form 1116. If you choose this simplification, you must apply it consistently to all your foreign source qualified dividends and capital gain distributions for the year. Just add them in unadjusted. This is a fantastic example of how knowing the rules can simplify your life and prevent headaches, especially for people with smaller international investment portfolios. It's a genuine shortcut provided by the IRS.
That exception sounds incredibly helpful for many people. But if you don't qualify for the exception, maybe your income is too high, or you have more than $20,000 in foreign dividends gains, or perhaps you just choose not to take the exception for some reason. How exactly do you make these adjustments? What's involved in that more intricate calculation?
Right, if the exception doesn't apply, it definitely gets more intricate. You'll need to pay careful attention to detail and likely use specific factors or worksheets from the Form 1116 instructions. For foreign source qualified dividends or capital gain distributions, like for mutual funds, you generally need to multiply the foreign source amount within each separate income category by a specific adjustment factor. This factor aligns with a preferential U.S. tax rate applied to that income on your return. If the income is taxed at the 15% U.S. rate, you typically multiply the foreign source amount by 0.4054 for 2023. Check current year instructions. If it's taxed at the 20% U.S. rate, you multiply by 0.5405. Again, check instructions. These adjusted, smaller results are what you then include on line 1A, foreign gross income, of the applicable Form 1116. And importantly, any foreign source qualified dividends or capital gain distributions that are taxed at the 0% U.S. rate are not included at all on line 1A of Form 1116. Why? Because there's no U.S. tax being imposed on that income, so there's no U.S. tax against which to claim a foreign tax credit for it.
Okay, so specific factors reduce the qualified dividends included based on the U.S. tax rate. What about other foreign capital gains or losses, like from selling stock directly?
For other foreign capital gains and losses, the process is usually even more detailed. You generally must use specific worksheets provided right in the Form 1116 instructions, typically called Worksheet A or Worksheet B, or you might need to refer to Publication 514 for guidance. Worksheet A has certain conditions for its use, like having foreign source capital gains or losses in no more than 2 separate income categories and meeting certain criteria related to how your tax is calculated overall. Worksheet B is generally for more complex situations involving multiple categories or other specific scenarios. Before you even start these worksheets, you usually need to reduce any foreign source long-term capital gain by any amount you elected to treat as investment income on Form 4952, line 4G, investment interest expense deduction. That specific elected amount goes directly to line 1A without this capital gain adjustment. And always keep in mind the overall limitation on deducting capital losses on your main tax return, generally only up to $3,000, $1,500 if married filing separately, against ordinary income per year. This overall limit affects how foreign capital losses factor into your Form 1116 calculations as well.
And these adjustments, they aren't just for calculating your foreign income in Part 1, but they also affect your overall worldwide taxable income figure later in the form.
Correct. The same underlying principle reflecting the impact of preferential tax rates applies to your worldwide taxable income figure on Form 1116, line 18. If you have qualified dividends or capital gains anywhere in your income, U.S. or foreign, and you don't qualify for that valuable adjustment exception we discussed, you'll likely need to use the specific worksheet for line 18 provided in the Form 1116 instructions to adjust your total taxable income figure before entering it on line 18. This adjustment ensures that your overall U.S. taxable income, which serves as the denominator in your foreign tax credit limitation fraction, line 21, accurately reflects the impact of those lower tax rates on dividends and gains. Proper adjustment here on line 18 is absolutely crucial for calculating an accurate and optimized foreign tax credit limitation. It's all about making sure the credit you claim properly aligns with the actual U.S. tax burden across all your income.
Okay, this has been an incredibly detailed deep dive. We've covered a vast amount of ground on Form 1116 and the foreign tax credit. For our listeners who maybe want to explore further or perhaps need specific guidance tailored to their own unique, maybe complex situation, what are the best, most reliable resources they should turn to next?
Yeah, that's a great question because tax rules change. The IRS provides several excellent resources that are really indispensable for navigating Form 1116 and all the related international tax issues. Given how dynamic tax laws and regulations can be, you should always start by checking irs.gov Form 1116. That's the official source for the absolute latest version of the form, the instructions, and any future developments or changes related to Form 1116. Additionally, several specific IRS publications are really indispensable for getting more detailed guidance and seeing examples. Publication 514, Foreign Tax Credit for Individuals. This is the big one. It's the comprehensive guide specifically for figuring the foreign tax credit. It's your primary go-to resource for detailed examples, deeper explanations of the rules, and covers many more intricate scenarios than we could possibly get into today. Publication 54, Tax Guide for U.S. Citizens and Resident Aliens Abroad. This is essential if you're actually living outside the U.S. It covers many aspects of foreign income, residency rules, exclusions like Form 2555, and how they all interact with U.S. tax obligations, including the credit.
Publication 519, U.S. Tax Guide for Aliens. This is geared towards non-U.S. citizens or resident aliens who need guidance on their U.S. tax responsibilities and how foreign income and the credit might apply to them. Publication 570, Tax Guide for Individuals with Income from U.S. Territories. This provides very specific guidance for income from places like Puerto Rico and American Samoa, which have unique tax relationships and rules with the U.S. And for direct assistance, if you happen to be overseas and have specific questions that these publications don't fully address, you can try calling the IRS International Line at 267-941-1000. Do note that is not a toll-free number. Or you could write to the Internal Revenue Service, International Accounts, Philadelphia, PA 19255-0725.
These resources can provide invaluable support for the inevitable complexities that arise from unique international tax situations.
Wow, what an incredible journey through the twists and turns of Form 1116. It's really clear now that understanding this form is far more than just, filling out boxes on a page. It's genuinely about strategically managing your tax liability, actively working to avoid that unfair double taxation, and ultimately keeping more of your hard-earned money right there in your pocket. From that initial, potentially simple election to avoid filing the full form, all the way through to those really nuanced adjustments for qualified dividends and capital gains, every single detail can genuinely impact your final tax bill. It really is a powerful tax-saving tool when you understand it and apply it correctly.
Indeed. Yeah, the foreign tax credit, when it's correctly calculated and applied, it's really a testament to the idea that knowledge is power, especially financial knowledge, right? It empowers you to navigate the complex global financial landscape with much greater confidence. It transforms what might seem like just daunting paperwork into a real pathway to tangible savings and, frankly, genuine peace of mind. It allows you to operate globally, invest globally, work globally without that constant fear of being unfairly penalized by two different tax systems hitting the same income.
So, thinking about all of this, what does it all mean for you listening out there? Reflecting on these nuanced tax rules, how might understanding the foreign tax credit empower you to think differently now? Maybe about pursuing international investments you were hesitant about, or accepting that exciting overseas job opportunity, or even planning for retirement abroad someday. How might this deeper understanding open up new financial horizons that perhaps you previously thought were just too complex, or maybe too costly from a tax perspective? What opportunities might you now feel confident enough to explore, knowing you have tools like Form 1116 to manage the tax side?
We definitely encourage you to explore those resources we mentioned, especially Publication 514. And look, if your situation is complex, maybe you have multiple income categories, significant foreign assets, loss carryovers, or treaty issues, seriously consider consulting a qualified tax professional who specializes in international tax. Your financial well-being often hinges on getting these details right, and professional advice can save you significantly more than it costs in the long run, both in taxes and potential headaches.
Absolutely. Join us next time for another deep dive, where we'll continue to unpack complex topics and give you the knowledge you need to be truly well-informed. Until then, keep learning, keep questioning, and keep optimizing.